Today, I'm going to show you how I use my stock analysis spreadsheet as a critical part of my stock picking process. It's a free resource that you can download for yourself, and it will help you calculate growth rates of a business's fundamentals, assess a company's debt, return on invested capital, and importantly, calculate the value and buy price of stocks. In this video, I'm going to be showing you how to find the appropriate financial data using some other free resources, and how to fill out the spreadsheet, as well as some tips on how to interpret the data to help you improve your own stock analysis. The particular structure of my spreadsheet isn't just created out of thin air, but rather based on the fundamental value investing principles laid out by Warren Buffett and Charlie Munger, two of the greatest investors of all time. And I've personally been able to apply these principles for the past 6 years, beating the market even through a recession in 2020 and a significant stock market crash that happened last year in 2022. The first thing you want to do is go ahead and download a free copy of the spreadsheet by using the first link in the description below. Enter your email address and you'll be emailed the download link for the spreadsheets. And don't worry, you can immediately unsubscribe from future emails if you wish, but if you do stay subscribed, I occasionally send out additional resources that I don't share anywhere else, so there is actually some value in staying subscribed to the newsletter if you want. After you get the link, there is a choice of 4 spreadsheets, either a 5-year or a 10-year sheet, and then either a 2022 or 2023 spreadsheet, depending on whether the latest financial report for that company is the 2021 financial year or 2022. Click the spreadsheet that you want and it will take you to the public template. Importantly, you can't edit the template, but what you can do is click File, make a copy, and save a copy to your own Google Drive, and of course you will be able to edit those copies. You'll notice in the spreadsheet that there are white and gray cells. The white cells are the ones that you're able to edit. Leave everything else, as there may be formulas that you don't want to mess with. To start off with, change the name of the spreadsheet to the company that you're analyzing and enter the ticker symbol for that company in the top left of the data input tab. You'll notice that we then need financial data for sales, earnings per share, equity, operating cash flow, current assets, current liabilities, and total liabilities. Now, you can get this data from a lot of different websites, but two of the best websites that I use are TIKR.com and quickfs.net. Both of these websites have free accounts where you can access 10 years of data, so you can fill out these spreadsheets for free. But if you are looking for a more comprehensive tool, then I highly recommend TIKR. I am partnered with TIKR, and if you use my link down in the description below, you'll get the best deal on a premium account if you want. But as I just said, both accounts or both websites have a free account where you can access enough data to fill out the spreadsheet anyway. If you're using TIKR, for example, simply look up the stock and you'll be able to find sales and earnings per share data on the income statement. On the balance sheet, you'll be able to find equity, current assets, current liabilities, and total liabilities. And then on the cash flow statement, you'll be able to find operating cash flow, or as it's listed, cash from operations. Once you've entered in that data, you'll notice that some of the graphs and other formulas will begin to calculate, but we do need to fill out the whole spreadsheet before we can begin interpreting the data. So next, you want to head over to the CAPEX tab and enter the capital expenditure figures, which again are found on the cash flow statement under the investing activity section. Now, for simplicity, you can just leave the CAPEX tab there, but if you want to be more accurate in your analysis, what you will want to be doing is figuring out what proportion of total CAPEX is used for maintenance. I won't go into that in detail in this video, but I do have a video specifically for that. I'll leave it linked down in the description below if you want to check it out after this video. Next, head over to the ROIC tab, which is the return on invested capital tab, and you'll need to enter in the data for long-term debt, which again is found on the balance sheet. And that's everything you need to enter in except for the valuation and buy price calculator, which I will talk about in just a second. But before we get to that, we can do some interpretation of what we have just filled out. Back on the data input tab, you can see there's 2 graphs. One shows us revenue and cash flow, and the other one shows us margin and how those have changed over time. I look for companies that have consistently growing revenues and profits and either stable or increasing profit margins. And you can also compare the profit margins of a company to similar businesses if that's applicable for the particular business. The debt ratios tell us about the financial health of the business. A lot of people will do super in-depth debt analysis to figure out the likelihood of a company going bankrupt or being able to finance their debts. I do a very simple process of debt analysis, which is that if a company has a lot of it, I'm not interested. So essentially, I'm simply looking for a really high current ratio and a really low, below 1 debt to equity ratio. On the data input tab, we can also see some information about the return on invested capital, but we can look into more detail on the ROIC sheet itself. Pretty simply, I like companies that are able to generate high returns on the capital they invest, and by high, I typically mean more than 10 to 15% per year consistently over time. On top of this, even better companies are ones that can generate high returns and can grow. So in other words, they have the opportunity to reinvest their profits back into the business to compound their growth over time. And we can look at the sheet to see this by comparing the total cash flow produced by the business over the past decade to how much equity has increased. And this gives us a rough guide of how much of the profits over the last 10 years have been reinvested back into the business as opposed to, say, distributed to shareholders in the form of dividends. The growth tab gives us compounded growth rates over different periods for the fundamentals. I look for companies that are consistently growing at double digits over a decade. And in the best case, I look for companies where the growth is accelerating over time, so that the slowest growth rates that are still decent growth rates are the long-term growth rates, and they're actually improving over time. But ultimately, the consistency of their growth is more important to me than the magnitude. So even if a company isn't growing at double digits, if they have a consistent ability to grow year after year, then it can be a good indication that the business likely has some competitive advantage over the other businesses in its industry. Again, I have a bunch of videos talking about return on invested capital, debt, and economic moats and competitive advantages, all on my channel. I'll leave a link to a bunch of videos down in the description below. So that brings us to the final part of the spreadsheet, which is the valuation. And this is where we can essentially model out the future profits of the business and therefore come up with an estimate of what we're willing to pay for the stock. And I know there's a lot of numbers on the screen, but it's not as complicated as it seems. There's simply room to create 5 different models so that you can create a range of future outcomes, a range in which intrinsic value or the value of a business likely sits. You'll need to enter in the year 0 profit figure, which is typically last year's cash flow for owners figure, or in some cases, a 5-year or a 10-year average from the past 5 or 10 years is what will be appropriate given the particular business or industry. We then need to estimate how quickly profits will grow per year over the next decade. This is by far the most difficult part of stock analysis, and I cannot stress enough the importance in being extremely reserved in your projections to mitigate against you overestimating the potential of a business. One of the biggest mistakes I see people make in valuation is they look at the recent past and they just extrapolate that recent performance into the future. You need to do a lot more critical work in terms of how the industry looks and what the competitive landscape is, as well as the actual physical ability of that company to grow. Do they need to open more stores? Do they need to have this certain number of subscribers? What is possible for the business, and not even just what is possible, but what is very likely to occur given the business's current trajectory. If you do want to take a course on valuation, I have one in my investor community, which you can currently join for just $9.99 a month. So if you want to check that out, again, linked down in the description below. You then want to pick a required rate of return, which is your personal target return. So what you personally want to make. You need to pick a terminal growth rate, which is an estimate of how profits will grow after the 10th year. Typically, you want to leave this at 0%, but at the most, leave it at 3%. Because this is a perpetual growth rate, you never want to put this above what the economy is likely to grow at. So that's typically 1, 2, or 3% at the most. But typically, leave it at 0. We then pick a margin of safety, which I always leave at 50%. And this essentially allows for errors in our valuation, as well as random unpredictable events that can happen in the financial markets that impact our valuation. Finally, grab the cash and cash equivalents figure from the balance sheet, and then grab total debt, which is listed under 2 items, which is short-term debt and long-term debt, which you need to add together. The spreadsheet will calculate the fair value for the whole business, which is essentially what you've valued the business on based on your assumptions. It will then give you fair value per share, which is the same figure, but on a per share basis. And then the buy price is the fair value per share after subtracting a 50% margin of safety or whatever margin of safety you've selected. A couple of important notes for the per share data. Sometimes Google Finance gets this wrong. So what you'll want to do ultimately is manually change the per share figures, which is simply a process of going to the latest quarterly or annual filing, and on the front page, you'll see how many shares outstanding there are, and then entering that manually into cells H9 to H13 as the denominator. Also, and this is critically important, just because it's easy to stick numbers into this spreadsheet does not mean that it's easy to value companies. It is not. And for many people, picking individual companies at all will not be appropriate for your financial circumstances. So if you're ever unsure, it's best to talk to a professional to see what is appropriate for your financial circumstances. Again, if you want to learn more about analyzing and interpreting parts of this spreadsheet, there's a ton of resources that I've linked down below, so you can go wild. There's a ton of stuff to go through. The link is to the spreadsheet is also down there. First link in the description below. Link to TIKR if you want to sign up to a premium account and support the channel in a little way. That's linked down there. Everything you need is linked down there. But I hope you guys enjoyed this video, and I'll see you in the next one.